Powell's just reloading his two revolvers because he only has two tools, rates and balance sheet. And he needs higher rates now so he can reduce them when we have no doubt that we're in a recession. And he needs a thinner balance sheet so that he can fatten it when we need to print more money. I think he's just buying ammunition and buying time. We will pivot. And again, Ronnie Sturfula, myself, Rick Rule, certainly Groman, we all agree on this. I think even Brent Johnson agrees at some point. It's not 50 years from now. It's not even 20 years from now. It's when things really break. To me, they're already broken. It's not even a soft landing. We can get into the data on that. We probably need more than a half hour on that. We're massively in a hard landing now, from Main Street to Wall Street to banks, in my opinion. But the Fed will at some point get to the point where they're going to have to either reduce to QE or refill the TGA, or they're going to go to yield curve controls, unless, again, we cut spending by 70%, which I don't see possible. I don't see any way out other than more synthetic mouse click money.
The yield on 10-year U.S. Treasuries reached 5% on the 19th of October, a 16-year high as the Federal Reserve continues to sell its assets. What does this mean for the economy? Growth or pain ahead? Discussing this with us is our next guest, Matthew Piepenburg, author of Gold Matters, Real Solutions to Surreal Risks, and partner of Matterhorn Asset Management. Matthew, welcome to the show. Good to host you today.
Great to be here, David. I'm looking forward to it. Appreciate the invite.
Now, the bond yield ticking up, what is this signal? Going back to my introduction, is this, some may say that rising bond yields, especially Treasury yields, may signal actually an improving economic outlook from the markets as people sell off treasuries. Is that what's going on right now?
Well, Janet Yellen will tell you that, rising yields are a good sign, strong sign of economic growth. I think it's deficit driven. And I think we're a bad credit with a declining asset in our US 10-year, and certainly on the long end of the curve. The bond market to me is everything, but no, I don't think it's a positive sign. I think it is, again, deficit driven, debt driven. Rising rates obviously impact bond prices negatively and send yields up. I think the Fed is in a vicious circle. But the short answer to your question, David, is when you have rising yields, rising GDP, and rising deficits, to me, that's more reminiscent of an emerging market, not a strong, robust, developed economy. And the U.S. just, frankly, isn't what it used to be.
I'm reading reports that BlackRock stated we think 10-year yields could reach 5% or higher on a longer-term horizon. First of all, what does this mean for the consumer?
Well, look, the consumer is the most ignored thing in the markets these days. Wall Street has certainly benefited from Fed policy since, or at least since the Great Financial Crisis. But of course, for Main Street and for the consumer, rising rates are an invisible tax. In addition to inflation being an invisible tax, rising rates, are a direct tax. Things just cost more. Governments live on debt, corporations live on debt, and individuals live on debt. And when the cost of that debt gets higher, it just is more painful, and that hurts the consumer. And of course, the consumer is 70% of our GDP. And right now, I think our GDP is driven again more by, frankly, deficit spending and, solving a debt crisis with a debt crisis or with more debt. And so, no, it's ultimately very negative. This combination of real inflation, that is the inflation not reported by the Bureau of Statistics, more like what John Williams and you discussed a few weeks back, that's inflation. It's probably higher than 11%, not the bogus scale that the BLS uses. So when you combine this invisible tax of inflation with rising interest rate costs. And again, a typical consumer, a typical Main Street citizen pays 18 to 20% on their credit card. They're not getting the Fed funds rate, and they're not getting discounted rates or IOER. So it's a terrible scenario for the consumer at the end of the day, David.
So interest expenses is a cash flow outlay that is one side of the equation. I've heard the counter argument, which is that higher interest rates mean higher interest income for those holding treasuries, especially those companies holding treasuries on their balance sheet, boosting their non-operating income. How would you respond to that?
There's a couple ways. I mean, again, the typical bond cycle, you'd say, look, yields are great, bond prices are down. It's a value opportunity. Let's buy these 10 years, these 30 years. They're declining in price. Let's get in and hold them to maturity, and we'll get a nice match. I think that might have been true for the last 40 years, but when you have debt to GDP at 120%, when you've got a 6% deficit to GDP, and when the net investment income, when we're basically not in the same bond cycle we were 40 years ago, the debt levels are just too high. So I don't see this as your average bond market. I don't think this is yesterday's bond market. I think the bond market is at a point of no return now for a number of reasons. You could argue that, well, if yields are great, it's a better return. The dollar's going to get stronger. It's the best horse in the glue factory. It's the best bond value you're going to see in a long time. But I think bonds, U.S. sovereigns and British gilts are going to continue to decline because they're under this higher for longer policy, ostensibly to fight inflation, which again we can get into. I don't think that's the real motive with Powell, but no, I don't think it's the end for bond prices falling. So you're buying into an asset that's going to continue to decline. If bond prices rise and yields compress, that'll only be because the Fed is done some type of pivot. Don't ask me when. Short term, long term, it's inevitable. So when the Fed pivots and supports yields at a lower yield compress at a higher bond price, that's just going to mean inflation's higher. It's just still going to get a negative return, in my opinion. I think there's no way out now for this bond market. It's really reached a threshold, an inflection point at a number of levels, whether you're looking at inflation, looking at yields, you're looking at yield to maturity. It's just not my dad's and grandfather's bond market anymore, given the debt levels that we're at now.
Do you know where the capital is flowing? If people are selling off bonds, certainly not going into equities. That's had a huge, the equity indices have had a pretty bad month, as you know. So I'm wondering where the capital is going.
Capital's confused right now. I mean, again, we can look at just at the U.S. Treasury. Look, since 2014, central bank reserves around the world have been in decline, while U.S. Treasury supply is an uptick. So you've got a massive mismatch in supply and demand on U.S. Treasuries. It's no longer the risk-free asset or the risk-free return. It's return-free risk when you measure it against actual inflation. And then, of course, when interest rates go up, stocks and stock markets are affected by higher costs of debt. Corporate debt's now 22% more than it was a year ago. You've got 400 bankruptcies filed this year. You've got layoffs at some of the big names. People really don't know where's the safe haven. Of course, I'm a gold bear. I'm a gold executive. I have a gold bias. Precious metals and other hard assets are where the world is turning. Investors, BRICS nations, central banks, they're dumping treasuries and stacking precious metals and other real assets. Even the BRICS nations are arbitraging their deltas with real assets, not U.S. dollars and U.S. treasuries. Again, to Brent Johnson's point, it's not the end of the U.S. dollar. It's not the end of the world reserve currency, but the dollar and the IOU from Uncle Sam is just not even close to what it used to be. So where do investors go? I kind of think they're following the central banks. There are still a lot of retail investors buying long duration risk, long duration treasuries, because they think it's just another bond cycle. But again, to my earlier point, with debt levels where they are, it's not another bond cycle. It's the end of a cycle.
You are an expert on gold. You've written a book called Gold Matters, Real Solutions to Surreal Risks. So I want to come back to gold and your thesis there. But going back to the U.S. economy, the federal debt has reached more than 120% as a percentage of GDP. Interestingly, the deficit is closing. It was negative 14% in 2020. It's now currently negative 5% as a percentage of GDP. Does this indicate that the current debt environment and perhaps the deficit environment could be sustainable, Matthew?
You could make that argument. I would disagree. There are many who want to believe that. I think, look, the U.S. policymakers right now are looking at another 1.9 trillion in spending before the end of this year, another 5 trillion next year into 2024. They're just, I've used the joke over and over, they have a busboy salary and a Ferrari appetite. In other words, they want to spend and spend. They don't have the income for it. So I don't see any way around our twin deficit problem. We still have a massive problem with fiscal policy, and right now a hawkish monetary policy out of Powell. You're getting a more dovish monetary policy out of the Treasury under Yellen, and almost you have a yin yang between Yellen and Powell. But no, the way America is spending, we're not getting out of this deficit problem. And when you cross the Rubicon of 110, 105% of debt to GDP, and you hit 120. When you look at tax receipts, as interest rates goes up, the percentage of those tax receipts to pay interest expenses gets more and more painful. At 3%, at 6%, at 9%, you get to the point where the interest expense on our government IOUs becomes 30% of our tax receipts. That's just debilitating to the bond market, to the banking sector, to the economy. So no, I don't think this kind of trimming down of deficit numbers is really going to change the larger effect that we just spend more than we make and we issue too many IOUs as a nation.
All right, well, we've spent some time talking about the fixed income market. Let's back up for a minute. I was talking to you offline, and you mentioned that your general outlook on the macro landscape is rather bleak. Why is my question.
And again, I have to caveat this by saying, because I'm very sensitive to the legitimate criticism that many peers in my industry, and whether they're mining, gold mining, precious metal miner, precious metal brokers, precious metal storage facilities, there's a lot of sensationalism in the space, and we saw that in July and August with this hype about the gold-backed currency out of the BRICS, and et cetera, or it's the end of the world. But the truth is, I've always said, I do look at the macros. I do think debt matters. Even when I was an undergrad studying philosophy, I remember David Hume, debt destroys nations. It does. It does throughout history. You don't even have to look at economics. You can just look at history and you see it over and over. And you could stovepipe into any section in the calendar on the map at any time in history. Debt does destroy nations. The US is not exempt from that. But yeah, my macro view has been and continues to be very dark. And my themes are not any different than they were 2 or 3 years ago, that just the numbers have gotten worse. And my theme is that when you do cross the debt threshold where it's no longer sustainable, where when you're solving a debt crisis by issuing more debt and monetizing that debt with money created out of thin air, you're really running uphill in very slippery roller skates. And we're past the point where there's an easy scenario. The monetary policy, the Fed can support the bond market or it can support the currency. It can't support both. And at some point, like all nations throughout history, we're going to sacrifice the currency to support the system, not just the bond market, because the bond market supports the pension system, it supports the S&P, it supports tax receipts. In other words, we'll debase and inflate our currency and destroy the inherent purchasing power to keep the system alive. And then we'll blame that debasement on COVID, Putin, whatever headline makes sense. Or I joke, little green men from Mars. It will never take responsibility for the fact that we're just living beyond our means and creating money out of thin air to pay for it.
I have a quote here from another gold investor, Peter Schiff, someone whom you may be familiar with. This is from his Twitter. Argentina's present provides a glimpse into America's future, where the central bank raised interest rates 15 percentage points to 133% on October 12th, but with inflation running at 138% and budget deficits and debt rising, the rate hikes will have no effect on reducing inflation. Speaking of sensationalism, is this just sensationalism, or is this actually, does he have a point there? Is this the direction of America heading towards Argentina, Venezuela, and other super high inflationary environments?
Well, I've written articles about the U.S. being effectively just another banana republic. I think to compare the U.S. to Argentina or Venezuela is a little bit sensational, although I ultimately agree with Peter's longer term thesis. The difference between Argentina and Venezuela, or even other inflationary stories like Yugoslavia in the 90s or Weimar in the 30s or France in 1789, when you debase your currency. But the difference today is that the U.S. is still the home of the world reserve currency. Argentina is not. That does not mean, though, that the U.S. is exempt from the simple rules of supply and demand, or when you expand the money supply to a grotesque or basically irrational level, that you inherently debase the purchasing power of the currency. I don't think we're heading towards Argentina levels, but we are at a point now where what Lou Groen has called fiscal dominance, and even the St. Louis Fed in June, when you quote unquote are fighting inflation by raising rates like Volcker did, well, then let's measure rates and let's measure inflation by the same scale that Volcker did. We're at a point now where when we raise the interest rates, the Fed funds rate, the cost of Uncle Sam's debt becomes even more expensive. The only way to pay for that isn't coming from GDP. It isn't coming from tax receipts. You have to create more synthetic liquidity, which is inherently inflationary. So our war on inflation is inherently inflationary. Even our Inflation Protection Act is a spending bill. There is no way around inflation other than a massive disinflationary event like a market crash, or if we cut military and entitlement spending by 70%, maybe we could do that. That's not going to happen, I think, in my lifetime. Politicians can't get elected on that type of austerity. So there is no way, to Peter's point, around the inflation spiral we're in, the debt spiral we're in. There just isn't. We've crossed that Rubicon. There's no way other than massive entitlement and military spending cuts that just won't happen, or some magical, energy solution that isn't oil-based. And that's not going to happen either. So no, I don't think we're Argentina, because we are, like it or not, fairly or not, it's our currency, their problem, but it's also our currency, our problem now. But there's no way out of the inflationary cycle we're in now. We will print money to support our credit markets. That will be inherently inflationary. And we're not going to fight inflation by raising rates, because we're just making the cost of our own debt more expensive, which we can't afford unless we create more mouse click money. So I think we're at a point now we'll choose, just like Japan did, between the bond market and the currency. Japan's currency is down 25% on the vis-a-vis the dollar over the year to save their JGBs. Eventually, the U.S. will do the same thing as Japan. We're turning Japanese, but we are, unlike Japan, the home of the world reserve currency. We can get away with this longer and export our inflation to the rest of the world. The rest of that world's getting tired, but that's why you're seeing the rise of the BRICS Plus. They're slowly, not overnight, getting away from the US dollar, looking for alternatives to the US Treasury, and looking at real assets.
Speaking of the BRICS, were you surprised that at the last summit in South Africa over the summer, they did not discuss the possibility of a BRICS unified currency, something that is non-dollar based? It wasn't on the agenda, and the suggestion from Putin, or the Russians actually, that perhaps a gold-backed BRICS currency could happen. That again didn't happen, wasn't on the agenda. Did that surprise you?
No, it didn't, and luckily I can timestamp that by having interviews before the summit, or even at the summit. I was with Rick Rule, even before the BRICS summit. I was saying, look, first of all, I do see all the dangers in de-dollarization long term. I saw it from the day the sanctions started, but no, I did not see a gold-backed BRICS currency in August of 2023 for a number of reasons. But I've also said that doesn't necessarily have to be a BRICS gold-backed currency for gold to play a role within the BRICS system. I mean, they're already basically arbitraging the delta with hard assets and gold. They don't have to have that gold stored in some centralized place in Russia or redeemable by a Russian central bank or a Chinese central bank to still find trading networks, physical networks with gold as part of the exchange. It's basically a kind of a glorified barter economy that they can create slowly. Regardless of a BRICS-backed currency, though, the trend of getting away from the US dollar slowly, steadily, but surely is the real headline. But to think that that's going to happen overnight, or the BRICS-backed currency, I didn't think so for a number of reasons. I don't think any sovereign country, including the BRICS nations, want to give up the power or the right to possibly print more money in their own national central banks. And so they don't want to give up that power. Rick Rule and I agreed on that. I do think de-dollarization is a massive shift. I think the move into real assets, and gold in particular among the BRICS, is a massive shift. I think the fact that 44 countries are doing bilateral trade agreements outside the dollar is a massive shift. I think the fact that China can now buy oil outside of the US dollar is a massive shift. But again, to say that this is going to happen overnight, or the dollar is going to be destroyed, the world reserve currency is over, I agree with Brent Johnson. That's not going to happen overnight. What I disagree with Brent Johnson is I think the pace of is going faster than he would agree. And I don't think the US Treasury or the US dollar is the safe haven that he thinks is going to be in the next crisis. I just don't think it will. I could be wrong, but I don't think there's going to be a massive flow into our declining, unloved U.S. Treasury and our debased U.S. dollar. Not at the same level.
Mm-hmm. Right. Well, the common question I hear regarding de-dollarization is, what is the alternative if the world were to de-dollarize? What will they use instead?
Exactly, and that's the point that Brent makes, and many others that I agree with. It's not going to be the ruble, the yen. It's not going to be the peso. It's not going to be the yuan. So in terms of world reserve currency, the US dollar is still supreme. It's just its hegemony has changed dramatically. And no, and yes, I'm a gold executive out of Switzerland. It's not going to be the gold bar either. It's not going to be a gold-backed currency. But what you're going to just see is what we're seeing in the last 2 years: central banks dumping US treasuries and stacking physical gold at record high levels. And even investors, and we have investors that are high net worth and fairly sophisticated, they know there's not going to be a gold-backed currency either, like the BRICS, but they can become gold-backed themselves. We can each become our own central banker from our own home or our own vault or our own storage facility, however we choose. And that's what a lot of sophisticated investors do. And I'm not going to name names. I knew a lot of guys from Wall Street and the hedge fund world who are portfolio managers who trade in arbitrage, credits, equities, long, short, multi-strat funds, and they don't trade gold in their books that they take their 2 and 20 on, but when they have their own personal money, they invest in gold vaults somewhere outside of the US. And the smart money is basically trying to solve their own currency problem on their own. And retail investors are doing the same thing, where they put it in a shoebox or they put it in a private vault somewhere in the Swiss Alps. More and more people are catching on that the inherent purchasing power of their Canadian, Australian, American dollar, or of their euro or kroner or French or Swiss franc just isn't what it used to be, and is going to continue to get weaker as national decision makers debase their currency to pay off debt.
You wrote in a recent article that the Fed will choose to save the U.S. bond market through increased asset purchases, which will crash the U.S. dollar. First of all, isn't that the opposite of what they're doing, which is to decrease asset purchases? And second, can you explain the process of why asset purchases will crash the dollar?
I don't think it'll crash the dollar. It'll just continue to debase the dollar. I think, again, I don't want to say the implosion, crash, end of the world, but what we're doing right now is we're QTing, we're reducing our balance sheet and raising rates into a debt crisis. You had Richard Werner on the other day. That's not where QE works best. And it's really best in a deflationary crisis. We won't get into that stovepipe, but The fact that we're QTing or reducing the balance sheet and raising rates right now doesn't mean we're going to be doing that in the future. Don't ask me when the pivot comes. I think we've already had a backdoor pivot to the Treasury last
You've said that
October.
twice now. I'm inclined to ask you
Yeah.
when the pivot's going to come. I'm kidding.
Yeah. It's inevitable, but we will eventually have to create synthetic liquidity. We'll have to debase the currency to purchase our own IOUs. Right now, we're not doing that. I think Powell is only raising rates and reducing the balance sheet because we are already in a recession. We can go into that. When we're officially by the NBER in a recession, he's going to need to reduce rates and fatten the balance sheet, like he tried to do in 2018 and had to pivot by 2019 and unlimited QE in 2020. Powell's just reloading his two revolvers because he only has two tools: rates and balance sheet. And he needs higher rates now so he can reduce them when we have no doubt that we're in a recession. And he needs a thinner balance sheet so that he can fatten it when we need to print more money. I think he's just buying ammunition and buying time. We will pivot. And again, Ronnie Sturfula, myself, Rick Rule, certainly Groman, we all agree on this. I think even Brent Johnson agrees at some point. It's not 50 years from now. It's not even 20 years from now. It's when things really break. To me, they're already broken. It's not even a soft landing. We can get into the data on that. We probably need more than a half hour on that. We're massively in a hard landing now, from Main Street to Wall Street to banks, in my opinion. But the Fed will at some point get to the point where they're going to have to either reduce to QE or refill the TGA, or they're going to go to yield curve controls, unless, again, we cut spending by 70%, which I don't see possible. I don't see any way out other than more synthetic mouse click money.
Well, can you point us to some indicators that are showing the hard landing that's happening now?
Mm-hmm. Well, I mean, the hard landing right now is, again, well, you can look at the basic stuff we're just seeing on Main Street: layoffs at Spotify, Microsoft, Google, Amazon, even Goldman Sachs. Then you look at the 400 bankruptcies this year. You look at the cost of corporate debt. You look at the car delinquencies and car loan delinquencies and small businesses that are worse than they were, levels worse than we saw in 2008 in the great financial crisis. But, more simply, you just look at the Conference Board of Leading Indicators. It went dipped below that 4% threshold last December. In December, in my opinion, we hit recession last year, not when we just redefined the terms of recession in 2022. You've got inverted yield curve, and you've got year-over-year M2 money supply tanking. Also, the LEI, the leading Conference Board leading indicators, the change in the M2 money supply, the decline, and the inverted yield curve, and all those Main Street indicators, to me, don't suggest anything soft at all. And ask any of those people being laid off. Those 400,000 bankruptcies have employees behind them, and you look at 400 bankruptcies, top 10 of which leads to at least 200,000 jobs lost. Again, the robust labor data, again, like the inflation data, we could spend another half hour on how bogus that is. It's not conspiracy. It's not sensational. It's a long story, but it's a lagging indicator either way, the unemployment data or the employment data. So I think we're like that cartoon character already over the cliff spinning its legs. We just haven't fallen yet, but the data that's lagging, the data that's available, does not suggest anything soft to me at all. Then you look at the gilt crisis in 2022, you look at the regional bank crisis in 2023, you look at our S&P this year, there's nothing soft about our landing right now. What, the S&P is up 8%, led by 7 companies. They have about 30% of the market cap of the S&P. They're up 90+%, but the other 493 companies are basically in such a negative. So I don't want to be sensational. I don't want to just be that gold bull, but I don't see anything currently robust, resilient. Ironically, the only thing that is resilient is gold in a rising rate, rising DXY, although relatively lower than it was last year, rising rate, stronger dollar. And yet gold is the one that should be declining. It's not, because no one buys this idea that this is, I think smart money knows that, like smart BRIC countries, like smart central banks in the East, they don't trust the US dollar. They don't trust the US Treasury. They don't trust the viability of this higher for longer policy, and they understand the basic math that we're at 95 trillion of combined household, corporate, and public debt. When our public debt is at 33 trillion and counting, it's definitely going to cross into 34, 35 by next year. We are a bad credit with a declining IOU, but we are home of the world reserve currency. We can export that for a while until we can't. And that's the $1 million question. And I don't know, David, when that's going to happen, but it's already happening.
Now, going into your outlook on specific asset classes, we've talked about bonds. I'm guessing you're negative on equities as well, given your negative outlook on the economic landscape.
Well, yeah, because again, I joked before this call that I was a lucky IPO winner in the late '90s, but I did learn about risk assets after the fact. And, I talked to a lot of brilliant portfolio managers all over the world when I was allocating to them, not when I was running these portfolios. And I found that the best equity managers, the best stock portfolio managers were former bond jocks, or people who understood the bond market, because yields and costs of debt affect not just the bond market, they affect the debt rollover policies, the extend and pretend policies on the S&P. It's very simple. Low rates are a tailwind, rising rates are a headwind for stocks. So when you've got a higher for longer policy under Powell, the cost of debt's more, stocks are going to decline. We saw a massive decline in 2022, the worst combined stock and bond performance since 1871. It's not a coincidence. Stocks and bonds don't hedge like they used to. They're highly correlated now because of the debt levels. Again, it all starts at that debt. It's not my dad's bond market anymore. They're too correlated. Risk parity portfolios of stocks and bonds, diversified, are not going to help and have not helped investors. I think investors, and again, caveat, I'm a precious metal guy, but you could talk about real assets in general or commodities in general. Smarter money is going towards hard assets and away from risk assets. And if the Fed pivots and we get a tailwind, you'll get a tailwind. You'll see a rise in the S&P, but you'll also see major inflation eating away at those gains. So it's running uphill in roller skates. We're past the point of an easy solution. Like central banks, many investors are going towards hard assets. Like the BRICS are going toward hard assets and away from overinflated bonds and overinflated stocks. That doesn't mean stock markets can't go up and down, but the S&P was down 15% last year. Year to date, it's 8%. Hasn't even made back those gains, quote unquote, losses. So I don't think this is a resilient economy or a robust market. We're buying at the top. You don't have to be a hedge fund guy or a lucky bonehead like I was in the 90s to know that you buy at lows and sell at highs. No one does it. But those chasing tops right now at this debt backdrop, that's playing with fire, in my opinion.
Right. Okay. Well, turning to gold now, I spoke to an economist recently about the subject. He's also bearish on stocks and the economy for some of the same reasons as you are, although he doesn't hold gold. And I asked him why. He says, well, if you just look at the price action over the last 10 years on an inflation-adjusted basis, gold didn't go anywhere since 2011. How would you respond to that?
Well, again, I would say based on what inflation metric, and I know when Egon started investing in gold in 2020, Egon von Greyer's is my partner. Gold was at $300, is now almost at 2,000 a day. It's had its sideways moments, its rises and falls, but he would argue that it actually has outperformed the S&P on an inflation-adjusted basis. Depends on what definition of inflation, but I don't need to be an apologist on the debate of gold versus, say, cryptos or others. I'm not against these views. I have a simple policy, a simple view. The inherent purchasing power of the U.S. dollar since we went off the gold standard in 1971 has fallen by 98% when measured against a milligram of gold. I'm not going to measure my gold vis-a-vis the CPI scale from the Bureau of Labor Statistics because I think it's an open lie. Everyone on Wall Street knows that. We're underreporting and misreporting inflation by a multitude. But I just know this much, that no currency, no paper currency gives me more confidence than physical gold. So I don't even look at how you price gold, what, in US dollar? Look at it in the yen today. Look at it in the dollar. Look at it in the euro. Look at it in the Turkish lira. It's just that I don't have faith in paper currency. You get away from CPI, you get away from inflation. Look at paper money versus monetary money, and gold will be your best asset as a wealth preservation mindset. If I were looking purely at speculation, I'd be long crypto all day long, just on a speculation asset, because it has the same philosophical thesis as precious metals in many ways. The argument for crypto is that it's a finite asset, infinite duration, but finite supply. It's portable, etc. It's a better alternative than paper currency. The problem I have with it, and I'm not against it, guys like Larry Lepard and Ronnie Sturfel, who I respect, are very pro crypto. I'm not anti crypto. I'm not in the speculation game. Most of the time, I think the people I've known who've done well in crypto have never done it for the philosophical reasons that they're worried about their currency. They just see an incredible speculation play that has a good story behind it. And I hope crypto does well. I'm more boring. I'm not looking for speculation. Our clients at Matterhorn, they can speculate in other areas of their lives or other areas of the profession. They're just trying to preserve the euros, Canadian, American dollars. We've got clients from 90 countries in different currencies. They just know their paper currencies are getting weaker, and they're just trying to keep that hedged with gold, because gold doesn't rise. Fiat currencies just get weaker. And that's my main argument for it. It's not about comparing scales or time frames or inflation adjusted or what the S&P did in a given window. You can use statistics to make just about any point you want. It's just getting weaker. Fiat currencies are just getting weaker.
When you say that gold is a wealth preservation tool, can you just elaborate on exactly what you mean? It's preserving wealth against what? Against the erosion of the value underlying currency because of inflation?
It's
it protection against other
inflation.
currencies? Yeah.
Yeah, it's not even a currency hedge against other currencies or currency arbitrage. It's just that I joke that it's fire insurance for houses that are already on fire. I kind of joke about it. It's like the CDS to the MBS trade. When mortgage-backed securities were tanking, you went long CDS, just going long precious metals because it's like having flood insurance for a house that's already on the river and the water's rising. The inherent purchasing power of the currency is dying. It's burning in front of us. Despite the DXY or its relative strength, its inherent purchasing power gets weaker and weaker by the year. There are spikes where current purchasing power can shift higher or lower. The dollar can go higher or lower. To Brent Johnson's point, I agree. But the long-term trend is when measured against gold, it just gets weaker. Not every day, not in a straight line, but historically, I would much rather own I would much rather preserve my wealth in a monetary metal than in a paper asset, even if it's the world reserve currency, because this world reserve currency is in a historical debt pattern that it can't get out of without debasing it even further. I think people have cognitive dissonance. They still believe it's the bond market of 40 years ago or 10 years ago, or it's the US dollar when Kissinger and Nixon before they welched, but it's not. We're just not that same country. And I'm an American, I'm a patriot. I love the iconic America, but I see a debt-soaked America, a debased currency, an unloved IOU, and a monetary and fiscal policy that's completely at odds with themselves. And that's not to be doom and gloom. It's to be as realistic as I can. In Switzerland, where I work out of, for generations have always held a massive percentage of their wealth in gold because they've seen wars, cycles, inflation, deflation. America and a lot of people younger, like my daughters or my son's age, have never really gone through a real inflation pain or a real insult to their purchasing power or a real political or financial crisis or even a military crisis on our shores. So there's a kind of out of sight, out of mind mentality. Maybe the benefit of studying history or living overseas or living in Europe or looking at the purchasing power of my money has made me more cynical. But again, my clients, our clients, they're not against speculation. They're not against trying to make money in other areas. There's not many areas to go to right now, but their role with us is just to preserve the purchasing power of their currency in something that isn't paper. And what they do with the rest of their money is up to them. And what I do with the rest of my money is, frankly, at this point in my life, I'm not looking at speculation. I'm just trying to preserve it. I don't trust paper money. That's that simple.
What happened to gold in the last 30 days? It went up coincidentally with the 10-year yield. So that doesn't usually happen, but it did. Why?
Yeah, I mean, I was listening to Keith Weiner the other day. He did a good over at Monetary Metals. He actually says, yields and rates and gold price we've done studies on this. They're really not as correlated as people think. There's a lot of reasons. I mean, of course, the headlines out of the Middle East. There was a fear. There was a chaos index. There was just a overwhelming disgust with what's going on there. Fear of escalation. When fear and chaos come to the world, people go to something familiar, that old life raft that they were taught about from their grandfather, that boring, barbarous old, relic gold, that pet rock. But, central banks throughout the world aren't just collecting gold because it's a pet rock. I think they're collecting gold because they don't trust paper money and they don't trust monetary and fiscal policy at the leading developed economies anymore. And so I think gold is rising despite the DXY is at 106. I know it was at 112 in last October. The dollar, to Brent's point, is still the best horse in the glue factory. It's still the best currency in the world. But despite a strong dollar, despite rising yields, despite FFR rates where they are in the last 18 months, gold is being incredibly resilient. And now it's actually approaching all-time highs. Not there yet. And I'm not here to tell you when. But it's fascinating. I think it's a combination of fear. It's a combination of chaos. It's a combination of lack of distrust in the American narrative in general, politically, socially, etc. It's also a lack of trust in the American dollar longer term. I mean, it was James Turk is talking about default risk in the U.S. I don't see default risk. I just see a continuing get to the point where they're going to have to print more money to support those bonds and keep those yields under control. That will be inflationary. That will debase the currency. And I think people are realizing what's the U.S. going to do? Where's it going to get its growth from? What kind of GDP? We need 30, 40% GDP annually to get us back. We need to cut spending by 70%. It's never going to happen. So those who just look at the simple, stupid metrics of debt and spending don't see any way out for the dollar but something Japanese, where they're going to have to debase even the world reserve currency to support an over its ski debt problem, an unprecedented debt problem. And then we have a DC that can't even agree party to party or among parties and is going to do more spending next year. We simply are spending more than we make. Tax receipts and GDP don't pay for it. Currency is going to be debased. Again, we've had backdoor pivots to the BTFP, to the Treasury Department. We're going to have outright pivots or outright yield curve control. eventually. And I'm not talking 30 years from now. I'm talking in the next few years or even the next few minutes. I don't know. No one really does. But you don't need to be a weatherman to look out at the horizon and say, those are gray clouds. I got to get an umbrella and rubber boots on today. I don't know if it's going to rain at noon or 12:30 or 3:30. I just need to prepare for the rain. And I don't know what will be the headline. Will it be Martians? Will it be COVID? Will it be another pandemic? Will it be some other bad guy in the world? But the real problem with the US dollar isn't the BRICS, it isn't Putin, it isn't COVID, it's our policymakers. Generation since 71 that welched on the gold-backed currency, got rid of the chaperone. We've been spending more to get reelected or get Nobel Prizes by printing money out of thin air. It's not sustainable policy. A 10-year-old could see that eventually if you just look at the math. I'm not trying to be flippant. It just doesn't work. And I'm not trying to be dramatic either, because I don't think it's the end of the dollar. It's not the end of America. It's not the end of civilization. It's just not going to be the same 10 years as it was the last 10 years. And it's not the same dollar and it's not the same IOU. And the evidence is overwhelming. It's not even predictable. It's happening right now. The evidence of a soft landing is not here. The evidence of a hard landing is everywhere. The fact that gold is rising in this environment proves that people don't trust these currencies and IOUs anymore.
I just want to learn a bit more about the holding gold when currencies debase argument. So here's a pushback that I've heard. If your dollar or whatever currency you're operating in debases or depreciates in value, aren't you okay just holding literally any asset that's not the underlying currency itself? So for example, I'll just give you an extreme example. For example, let's say the US dollar depreciates by 50%. Well, a pack of bubble gum that was $1 is now $2. If you held bubble gum and traded it, you're up 100%. Right? So it's not just gold going up in nominal terms, it's everything else.
You could argue even stocks can go up too, and the bonds will go up. So just hold those. I mean, it's true. It's again, gold is not the solution to everything, but I think it's the most obvious. Some people buy sports cars or art or other things that aren't denominated in some fiat currency as some type of hedge. If there's a bubble gum or a baseball card that's worth more than $1, and it'll be worth more than the dollar you paid for it 20 years ago, that's a great asset too. Again, to me, gold is something that goes back millennia. You've all heard the argument, but it's not a barbarous relic, and it doesn't mean crypto is a joke and it's a joke. And you got the Rickards and the Shifts of the world saying they could be right, they could be wrong. I don't know. I don't see gold becoming obsolete because I don't see central banks buying bubble gum, baseball cards, or cryptos right now. They don't. And I don't see cryptos as a medium of exchange. Gold isn't either. I don't take a bar of gold to, Costco to get groceries or to buy a car. But what I do is I just convert it to any currency I want when I want at the rate that's at a higher rate when needed. But no, there are other ways to deal with inflation or debasement of the currency than precious metals, and you could argue crypto is one of them, and they could be right. I'm not against it, but I don't. And you could argue that the S&P in an inflationary market will rip too. And by the way, when gold's at 5,000, that means a loaf of bread is $50. So again, you're not making any money. And I'm saying that's right. We're a wealth preservation asset. It's not a speculation asset, which is why I trust it more than crypto. But yeah, it's like Rick Rule said. I own gold because I'm afraid it's going to go higher. I'm afraid gold's going to go higher. I don't want it to. I'm afraid it is because the dollar or the yen or the yuan or the peso or whatever country code you're in is getting weaker. And so, again, it's not to make me rich. Gold will not make you rich. Silver, maybe you could argue, could get them bigger multiples. Gold just preserves what I have. That's why it's a little bit less sexy than a lot of the asset classes people want to talk to. But Ronnie Sturfel had a great graph, called it the graph of the decade, of just the inverse relation between the S&P and the commodity cycle. If we don't support, we continue higher for longer, and the S&P tanks into a disinflationary, deflationary market, you're going to see a commodity super cycle. That's outside of precious metals. It includes precious metals. But again, you see those cycles. They last 13 years, 15 years. You just follow the trend, and you follow that decline in the S&P risk assets or other risk assets, and you go to hard assets like the BRICS, like the central banks are doing now. They're a little bit ahead of the game. The Eastern central banks, you look at flows right now, gold flows in the Middle East too. It's not the answer to everything, but I just follow the cycles. But I don't see a scenario where fiat currencies get stronger in any zip code right now. It's in even the home of the world reserve currency, which again, since 1971 is just another fiat, but it's still able to export its inflation because it has that massive power.
For sure. Closing off on themes of your book. Now, the title of your book is called Gold Matters: Real Solutions to Surreal Risks. We've covered several risks already. Can you highlight one or two surreal risks we haven't talked about that gold could be the solution to?
Well, again, when I wrote that with Egon, I came out after another book I wrote called Rig to Fail, which was more about central bank policy and the Wall Street Federal Reserve kind of dirty marriage. But the surreal risk is not just US debt levels. You could look at the European community, the European Union. You could look at the influence central banks have on price controls, on quote unquote capitalism. I call it feudalism because the vast majority of risk asset wealth goes to the top 10%. The S&P ripped since 2008. That's been enjoyed by really the top 80, 90, the top 10%, the bottom 90% have not enjoyed those results. But the surreal risks of the distortion of free market price discovery, the distortion of natural supply and demand, the need for constructive destruction. When you have natural supply and demand, bond markets go up and down, yields go up and down based on natural markets. Good companies survive, bad companies tank because of the policies we've taken since really 2008. But earlier, the real surreal risk is we're not going to have constructive destruction anymore. We're going to have destructive destruction because we postponed and postponed and postponed natural market forces for so long that things are going to get so bad that these risks are surreal. That sounds like gold bug sensationalism. You take the gold out of the equation, just look at the bond markets, look at the national debt, look at the Fed balance sheet. It isn't in a contained thing between the Treasury and the Fed. It does have an impact on money supply. Federal policy does. Fiscal policy is completely outrageous, the amount of money we spend that we don't have. So those are surreal risks. Take away the gold bug, take away the Swiss executive, take away my bias, and just look at debt levels in the US, the home of the world reserve currency, in Europe, in the rest of the world. It really is a convergence of David Hume's thesis: debt destroys nation. Again, go back to the Ming Dynasty, go back to France in 1789, go back to John Law in 1720, go to Weimar, go to Yugoslavia in the 1990s, go to, Spain in the 1930s under Franco, or Mussolini in Italy. Look at every crisis in politics and markets. It's always when there's an inflationary crisis, a debasement of the currency, and that's all because they were living on debt and not living on productivity. Go back to ancient Rome. And so I don't think that the US is an exception to that. These are all surreal risks historically, but they're actually surreal risks right now, real time, timestamp it today, not down the road, not at some high headline that's already we don't know. If you look at the data right now, just debt, look at the delinquencies, the bankruptcies, the layoffs, look at the yields, look at the distrust of our treasury, look at what central banks are doing with our IOUs. I don't see it as very positive. I don't see any green shoots right now. I just don't. And that sounds sensational. I get it. And if I were not listening, or if I were not coming from my perspective, it's just another gold bug, just another gold, just another gold bull pushing his book. And I get it. But the truth is, Egon and I joke about this. None of us need to be doing this for a living. We could be pushing bonds at Goldman Sachs for probably more sexy return, but we just don't need to do that anymore. We believe in this asset class. It doesn't solve every problem. It doesn't. It just solves one particular problem for wealth preservation. I don't think it's a great speculation asset. To your point, when gold's at 5,000, loaf of bread's going to be a lot more than what you're paying today too. So, but yeah, I see a lot of risk. And then you throw on, David, throw on the geopolitics, you throw on the debt risk, you throw on the social risk, the distrust from January 6th to what's happening in the Middle East, to what's happening with immigration policy in Europe and the US. Again, not taking a side on it, things are splintering, they're fracturing. And social, when you have a debt crisis, it always ends in inflation and debasement of the currency, social unrest, and more centralization from governments left or right. And that we're seeing right now in real time.
You can't hold bread as an inflation hedge because it's going to expire, unlike gold. But good points, Matthew. I appreciated your thoughts. Very thorough analysis. So where can we learn more about your work? So I mentioned you have a book. You have a newsletter as well. Where else?
Yeah, I mean, Gold Matters, you can get that obviously online anytime at Amazon. Egon von Greyerz and I and Ronnie Sturfula, all our articles are on, Ronnie's an advisor with Grant Williams as advisor to Matterhorn, but our articles are written every week on goldswitzerland.com. It's a simple URL. And we do a lot of interviews, but a lot of our written stuff is all there. It's all free. You can just go to goldswitzerland.com, and any of my latest thoughts are there, and Egon's as well. So he's definitely more iconic in the gold space than me. He's got some good thoughts.
We'll put the links down in the description below, so make sure to follow Matthew's work there. Thank you very much, Matthew. Appreciate it.
Thank you, David. Real pleasure.
And we'll speak again soon. Thank you for watching. Don't forget to like this video and subscribe.